Hi, Callie. It's nice to see you.
Kyla, it's good to see you and it's great to be here.
Yeah, congrats on your recent announcement of your new job.
Thanks. I still can't believe it's happening. I'm pinching myself. I think it's the coolest job in the industry with the best RIA around when it comes to teaching investors how markets really work.
Yeah.
So it's been an incredible few weeks so far.
Well, perfect, because that's what I want to talk to you about today is how markets really work. So there's been a lot of talk with markets and sort of concentration. The first half of the year is wrapped up surprisingly, and stocks are up about 14% heading into the back half of the year. And almost 60% of those gains were generated by five companies: Nvidia, Microsoft, Apple, Amazon, and Meta. Nvidia alone accounted for 31%, which is alarming. How vulnerable does this sort of concentration in these five main companies make the broader stock market?
Well, I think you have to first consider that market concentration or the fact that the biggest stocks drive all the gains is somewhat natural. They're the big companies for a good reason, right? They have huge competitive advantages. They make the bulk of profits. There's a reason why people are investing in them. So to a certain extent, when markets are going higher, most of the time they're being led by these bigger stocks. That being said, this type of market concentration we're seeing isn't very normal. It's market concentration is normal, but the amount of concentration these days has been quite unusual. And I think it is something to be concerned with. Of course, you don't want fewer stocks driving the gains because the flip side of that is not as many stocks are participating in the rally. I do think that we've blown that media narrative out of proportion a little bit. We've seen, I'd say more market stocks participating in the rally this year than last year. And to some extent, I think the argument is a little, do you see the cup half full versus half empty? Because, my whole stance on market concentration is that it's a bull market being held back. It's a bull market that hasn't really lived. And once we get lower rates, even modestly lower rates, we could see more stocks actually join this bull market. But I think that depends on your opinion of the economy. And if you think that the Fed will lower rates because of good reasons, because they think the inflation crisis is over, they declared a job well done, and they feel okay releasing some of the pressure on the job market.
Yeah, definitely more questions than answers right now. I think that, to the point of the Fed cutting rates and like, will that boost other stocks? The FT had this really good chart where it showed that if you backed out these five companies, the market was down. And so like these five companies are doing a lot of work. And so do you really think like a shift in monetary policy will help them capture more profits? Or like, why do you think that these stocks are having such a drag?
Well, if you think about monetary policy, it's essentially this lever that the Fed pulls to incentivize different behaviors with your money. When rates are high, you want to save a little bit more because that savings rate on your savings account looks a little more attractive. But when that savings rate is at zero and the Fed pulls the lever the other way, you don't have much to do with your cash. You have to, look at what you're getting in bonds, look at what you're getting in stocks. You are almost pushed to take on more risk to make that money. So when I say that Fed rate cuts could influence, how people invest their money, that's kind of what I'm referring to. And it just gives them more choices. I mean, so what you're talking about, Kyla, is on the business side of things, in terms of financing. How easy does it get for companies to really dream as opposed to, skate by with profits on cost cutting? And that's definitely a thing. I mean, if rates come down, companies can start raising probably debt and equity both a little bit easier. Debt's a little bit cheaper. There are intangible effects that happen when rates come down where people get more excited about the future. They feel that it's a little easier to breathe financially. So they're more incentivized to invest. So yeah, I think rates coming down can have a fundamental shift on how people think about markets and how companies operate. And it can benefit anybody from the AI stocks that we're all talking about that are leading the market to the smallest stocks that have gotten hammered by these rising debt costs at a point where it's extremely hard to be profitable.
Yeah. And I think like, of course, the stock market is not the economy, whatever, but it almost seems like the market is being an absolute punisher with some of these names. And, if you're not Nvidia, get out of the way. Like Nike, I think is down 30% on the year because they're like, nobody's buying our running shoes. And it just seems like the market is really kind of going after these names. Do you think that that's also part of the problem? Like the market is just, if you're not AI, it doesn't care?
I think that selectivity is one of the issues. Going back to, investors have this 5% savings rate staring them in the face. And at the same time, we're seeing these wide range of fortunes from a bunch of different companies. Small caps, I mean, are lagging the S&P 500, that big index of the 500 biggest stocks in the US. Small caps are lagging them by about 30 percentage points. And that's a really big gap when you think about, the fact that small caps normally lead early on in bull markets. So yeah, I think that there's a bit of selectivity going on where, investors know the stakes here. They know that, things are a little shaky at the moment. Growth is slowing. They need to clear that 5% hurdle, and probably 5% and change if you think about it, for taking on that risk. And they want to pick a company that they feel okay with when they're investing in the market. I think that there are a lot of things you could say there, and there are a lot of behavioral, trends to dig into there. But the bottom line is, it's just the bar is so much higher to pick a stock right now or to pick an investment. And people are gravitating toward AI because in part that's what's working, but also it seems to be a compelling story.
Yeah, yeah. All the hopes are in the computers, it seems. But, we're talking about the market being shaky and things being uncertain. But in your newsletter published today, you talk about how June was the calmest month for stocks in nearly 7 years. So why do you think that there's been such low volatility? And do you expect that to continue despite the relatively high uncertainty that we'll have over the next few months?
Well, I can't say this was on my bingo card for 2024. I got to a point in mid-June where, and this is how I think of content really, some things strike me and then I'm like, wow, I should dig into them more. But I got to a point in mid-June where I was just kind of, skimming markets like I usually do. And I was like, oh my goodness, we haven't seen a big down day in forever, have we? And I checked the data. Apparently, at the point that I checked it, June, I think the biggest decline in the S&P was like 22 basis points, which is teeny tiny. I mean, if that was the biggest drop in June, it would have been the calmest month in decades, probably. But last day of June, I think we had a 41 basis point decline. So that made it the calmest month in 5 years or so. So anyway, it was a really, really calm month. And it's crazy when you consider that all these cross currents are going on. You have the Fed with interest rates at 15-year highs. You have, all these political headlines coming out. You have a slowing job market, still solid, but definitely slowing. You have all this uncertainty about what companies are doing and which companies are leading the market and if that can continue. So when I come to a crossroads and what I'm looking at, I usually look back on history. And that's not to say that history is gospel, never is. But I think you can see some behavioral patterns in history if you look closely enough. And, honestly, we haven't seen a 1% down day, 1% being the level where Wall Street freaks out and says, okay, this is a little uncomfortable. We don't see this that often. We haven't seen a 1% down day since late April. That's quite unusual. And we're in a period of the year where a lot of people are at the beach. They're not around to buy and sell if anything happens. So you could see these, shallow, quick, sharp sell-offs that happen if, a somewhat nefarious headline crosses the tape. What I've been telling clients is that, you shouldn't be surprised to see these down days, even in healthy markets where you believe in the economy, you believe in the AI story, you tend to see these steps back. Stocks go up and down over time. And when you get closer, when you look on a day-to-day time frame, that randomness is a lot more heightened. So, looking into the summer, if we get out of the summer without a down day, without a 1% down day, it'll be the first time that's happened in 44 years, I believe. So reset your expectations. Down days happen. I'm not saying that we're going to see a big down day tomorrow or 2 weeks from now, but really make a plan for if we see a big down day or a series of a few big down days, because you can't control the future, but what you can control is your portfolio. And many investors have the ability, especially with so much cash on the sidelines, to put that money to work if we see lower prices.
Yeah. So if the market goes down, it's like, okay, this could be a good time to buy something that you've been looking at in the stock market for a second. Is that kind of not investment advice, obviously, but is that the idea?
Kyla, you know the phrase. Right. So the reason why we say that is because I don't know your financial situation if you're listening to this. And, depending on your goals and what you're invested in and your risk tolerance, you might take a different action than other people. But on the whole, when you're looking at the economy, when you're looking at the chance of a Fed rate cut that happens under the most ideal conditions possible, when you consider the fact that many sell-offs that we come across are sell-offs that last less than a month. The decline doesn't last for longer than a few weeks, and then stocks are back to their uptrend. I think it's smart to have that foresight and say, maybe I can take a little bit more risk there, especially if you ascribe to the classic buy low, sell high type of advice.
And a lot of people will say that we're overdue for a correction, cyclicality, we should be in a market correction, like the AI stocks have done too much. Do you align with that? Like, do you think that we're overdue for a correction, or do you think that this market can keep on powering ahead?
Well, I would never say that the market should be doing something. I think that points to, some kind of crystal ball type predictionary stuff. And I don't believe in that at all. I will never issue predictions. I'll be the first to admit that my crystal ball has been broken forever. And markets are truly random, right? They're a combination of behavioral trends and reactions to headlines. And over months and years, they're more a reflection of, profits in the economy. So I think it's hard to say what the market should be doing right now. That's my point. Is the market more vulnerable? Probably, especially because we have fewer and fewer stocks leading here, especially because we're in the summer months now where volumes just aren't that high, going back to people not buying and selling as much because they're at the beach. But do I think that, we're headed for a big market crash, like some people say? I think that's unlikely unless we see something big change in the economy or the way companies do business. If you look at the times when we have seen big market crashes, these bear market declines of 20% or more in the S&P, they've typically happened during economic recessions where people start losing their jobs, where consumer spending slows down a lot, where businesses, start forecasting, more ominous times ahead, and they start pulling back on their spending a little bit. And while we're seeing flickers of that here and there, the economy is still quite strong. So if we do see a sell-off, I would be shocked to see it become one of those big market crashes. I think a lot has to happen for that scenario to take place.
Yeah, and I think that's definitely, it's a year of uncertainty. And, without getting into the political angle of it, do you see the impact of the US presidential election as having a negative impact on the stock market, positive, or just an impact at all? It's a tough question to answer because it's so uncertain, but do you have thoughts around that?
It's tough, but we have to talk about it. I mean, we all know the election is coming up, right? God forbid we get one more headline about it. But it's at the forefront of everybody's minds. It's 4 months away, if you can believe that. And it's a scary event, no matter who's up on the ballot. We get these questions year after year. I know of the several elections that have happened during my career, every election feels like the last one, the big one, right? So it's important to talk about it because it's something that's happening. Whenever I talk about elections, I first, throw this out because I think this is the most important takeaway for every type of investor. Politics on a very broad scale do not matter for your portfolio. And I have a great stat for that has blown a lot of minds. I believe since 1900, I think that's as far back as you can go to say that this is true. Since 1900, every president has been in the Oval Office during a recession, except for Clinton in the 1990s and then Biden right now. And of course, you have the arguments on, did we hit a recession in 2022 with Biden? And I'm not making a political statement here. I'm just saying if you are basing who you vote on or what you do in your portfolio on the success of the economy or these broad policies, you're missing the point here because if that's how you're looking at it, then every president or almost every president has done a horrible job. And this is good. Like, you don't have to worry about the state of your portfolio because of who's in the Oval Office, right? Or historically you haven't. And, I would hasten to guess that, from here on out, it's less of a concern than you think too. Where it becomes more of an issue is when you're looking at sector investments and you're thinking about policies. Like, a really great example is the Inflation Reduction Act and the tax credits we saw for electric vehicles and the subsidies and credits we saw for manufacturing. This is all good stuff, but it could be at risk depending on who sits in the Oval Office, what happens to Congress. And if we see some of those initiatives roll back, we could see more sell-offs in the electric vehicle space. We could see more sell-offs in the AI space. You could just see a shift underneath in the markets. So think about sectors, think about individual companies you're investing in, individual industries. And then on a broader scale, remember that as headlines come out, people shoot first and ask questions later, right? Typically around elections, you do see some bigger moves. I think for each of the last 3 presidential elections, we've seen like a quick sell-off beforehand and then a quick recovery after. And again, history isn't gospel, but that goes to show you how people or investors approach the election on a behavioral scale. They step out for a minute just to see what happens, and then they step back in when the dust settles.
Yeah. Yeah. And I think the stat is the market trends up 53% of the time. So, what's it? The saying, time in the market is better timing than timing the market. Is that right?
That's the classic phrase. Yeah. Time in the market beats timing the market. And we wholeheartedly believe that over here at Ritholtz.
Mm-hmm. And I guess, I've actually moved some of my money to a high yield savings account because I can get 5%. That's been some of my investing strategy. And so do you think that for people, like, can we blame them for doing things like this, where it's like, you're getting this guaranteed 5% return? Do you think that works for some people so they don't have the worry that might be associated with the stock market? Or what do you think about the diversification between savings accounts and stocks?
Oh, absolutely. And Kyla, I have moved some money to a 5% high yield savings account too. I mean, these savings account are the best. Savings account rates are some of the best that we've seen in our lifetimes. So of course it's worth taking advantage of, with a bunch of asterisks beside it, right? And something that I've been thinking about lately has been the attractiveness of cash for investors our age, Kyla. And I know you're a bit younger than me, but millennials and Gen Zs and how they view cash playing a role in their portfolios. Because what I've heard from a lot of my friends and a lot of family members my age is this almost opportunistic, almost pursuit of cash, where they say, 5% with minimal risk, that's awesome. I'll take that all day. And on a spreadsheet, that's right. But when you start factoring in personal, slants to your portfolio, when you start factoring in these long-term goals, suddenly the question comes up on if you're taking enough risk. Because let's be honest here, the last time the Fed hiked rates, or the last time the Fed pushed rates up to where they are right now, was last July. I think it was July 26th. And sure, you probably got a 5% rate on your savings account a few days after that happened. But if you took cash, if you looked at it, if you took some of your savings, if you looked at cash as this opportunity to grab 5% with minimal risk, you missed out on a 20+% rally in the S&P 500. And again, you had to take on more risk to get that. But a lot of investors our age are in the prime position to take risk. And I'm not saying put all of your portfolio in Nvidia. Like, I'm not going that far down the spectrum, but I think it's really important to understand your balance when it comes to risk. Everybody talks about taking too much risk, but I think a lot of investors aren't taking enough risk. And you see that in this over allocation to cash. because we just haven't seen that 5% in our lifetimes.
Yeah, no, I think that's a great point. Yeah, it's because there are outsized returns to be had. If you get the right stock, or just S&P can go up 15-20% on a year, and that's massively beneficial. But talking about risk, let's talk about bonds for the final question. So given the lack of progress, or this stickiness of inflation rather, in the eventual return to rate cuts, what does that mean for the bond market?
Well, first of all, you have to think about the role that bonds play in people's portfolios. It's called fixed income. That's the best way to explain it. You get a certain yield on the on bonds that you invest in, and of course, bonds run the gamut when it comes to when it comes to the amount of riskiness. You can invest in a super risky high yield corporate bond. You can invest in U.S. Treasuries, which is about as riskless as it gets, and there are a lot of options in between. So when I'm talking about bonds, I'll say, generally I'm referring to treasuries. I'm referring to those more riskless bonds, but just remember that bonds can get quite risky too. But when we're talking about bonds, we're essentially talking about fixed income, focusing on that yield instead of that growth. And right now, the 10-year is a good bit above 4%. 4% is quite high for this point in history when you consider that the 10-year was around 2 to 3% in the 2010s. And that was about as high as it got. And, that puts bonds in a funny position, right? At least puts treasuries in a funny position. Bonds, the basic thing you need to know is that when prices go down, yields go up. So since yields are quite high, prices are quite low. So as you're an investor, or if you're an investor considering investing in bonds right now, you're looking at a very low price, a really high yield, a great environment to get that yield, but a particularly terrible environment to invest in treasuries for that protection, that that market move that you typically see happen against stocks, or that market move that protects you if stocks sell off. We think that could snap back to normal. If the Fed starts cutting rates, then we think that attractive yield on the 10-year and on treasuries could disappear. It could also disappear on your savings account for what it's worth. But also, if you're worried about the economy, history has shown us time and time again that treasuries have been a smart investment later on in economic cycles, right before a recession. Because if people are worried about the future, they move to what they think is certain. And there aren't many certain things in life. There aren't many certain things in the investing world, but U.S. treasuries have been as dependable as they come. So I say all this to say, bonds are in an interesting spot. I would focus a little bit more on the price instead of the yield right now. We think it's time to think beyond the, high yields and to think about how to allocate your cash in a modestly lower rate environment. And what that looks like is bonds for protection and stocks for dreams, stocks for hopes and dreams.
Stocks for hopes and dreams. That's quite a line. Thanks so much, Callie, the new chief market strategist at Ritholtz Wealth Management. It's been a pleasure.
Yeah, thanks for having me.